This 3-candle model is all you need to become a profitable ICT trader. Firstly, let us ask ourselves the question, what is a fair value gap? In the most basic definition, it is price jumps caused by imbalanced buying pressure and selling pressure at a given period in the market. The market will seek this area to allow fair value to both market participants that may have missed on the initial impulse. Throughout this entire video, I will go through the dumb money fair value gap model as well as the correct way to trade your fair value gaps all the way down to the ICT concepts that are required for the perfect fair value gap entry. And most importantly, I will teach you guys how to validate your fair value gaps instead of going for each and every single fair value gap and taking numerous amounts of losses before you actually get your one winner, which is only leading you down the path of repeated unprofitability. Disclaimer, this video is only for long-term investors and the actual traders who are on the path to profitability because they can focus on a single given task and execute upon it. If you cannot even sit through a video, how do you expect to have the patience required to qualify as a full-time trader? So use this time now to study and learn the concepts that will save you from 6 months of repeated losses and mistakes. Prerequisites for this video will be understanding the turtle swoop model and the candle range theory, which I've both made videos for. This will give you the given pass to now understand the advanced fair value gap theorem. What is the dumb money fair value gap? It is a fair value gap that holds no criteria, the basic model that we have all been shown. This lack of confirmations to validate a fair value gap leads to uncertainty when trading it in this spontaneous market. Just like any other model or strategy, without any rules or confluences, it only leads to pattern trading. Trading without awareness of the market environment. So now, how do we validate this basic 3-candlestick pattern? Firstly, we have to understand what we should not be doing when picking our fair value gaps. In this case, we have a bearish fair value gap. We're looking to sell down. However, we have sell side liquidity that price looks to end up taking out. What does this intend do to our fair value gap? It allows price to fully invalidate this, causing us to take a loss. So what should the first rule be to validate our fair value gap? It should be having liquidity not being against that chosen fair value gap. If you have a bearish fair value gap, you should always make sure that it is above the sell side liquidity. And you have a bullish fair value gap, you always have to make sure it is below any buy side liquidity. Now that we understand what fair value gaps we should be avoiding, what should we then use instead? This is one of the first models that I want to introduce you guys to. The fair value gap, which focuses on the second candle purging any liquidity created in the first candle of this fair value gap pattern. As you can see in this bullish example, the first candle over here gets swept by the second candle. As you see, the low gets swept out and we see price start to expand to the upside. We then see price make a quick retracement, quick reject of this fair value gap and then continue to the upside. So even though this model does not occur as much as the basic fair value gap model, it holds much greater value because of the liquidation that happens of the first candle. Now, we also have another model which is a lot more common but also still holds that exact same value. The liquidation before the gap. This is our normal basic fair value gap pattern. However, if you extend and look to the left, we always have to notice that we have had a previous liquidation. We have had a previous liquidation before price actually made this fair value gap model. So this always adds extra confirmation because now that we've had liquidation, we can now see price having extra volatility to impulse to the intended direction. As you can see right over here, we sweep this candle's pattern, then we start to extend to our fair value gap pattern. Candle 1, candle 2, candle 3, wick high, wick low, gap in price. Price rejects off of this point and continues to the upside. Now, and the very important theorem to understand is the two types of fair value gap fills that we have. The first one that we usually have is the immediate tap and go, where we have the fair value gap open up in price, and then we have price quickly tap into that area and then expand in the intended direction. Now we also have the prolonged reversal. This is now created as the breakaway gap where we don't see price make that immediate tap. Instead, it starts to move rally to the upside, sort of consolidate, and then eventually over a prolonged period of time, we see price now tap into the zone and then expand from that area. Usually the more coherent one that we always want to be looking for is the immediate tap and go, just because that extra validation that we know that we're already following the trend of the current market. As you can see right here, price makes this fair value gap and we don't see it get tapped into immediately. Instead, we see price make this long range all the way to the downside and then make this prolonged retracement, tap into the area. Now we have that major reaction. Here, fair value gap, we see price end with the third candle, and then the fourth candle is an immediate reverse back into that fair value gap and then an expansion to the downside. We then see price test this one more time in a prolonged reverse remodel where we see price now retrace all the way into the premium of this fair value gap and then once again make the expansion to the downside. So understanding both of these, so understanding the two main ways that price can fill out your fair value gap, it will also give you that clarity to then have the discernment for your next trade. If you're having a prolonged reversal, you should then start looking for lower time frame entry models. If you have an immediate reversal, you will then seek the candle range theory and the turtle soup model on your lower time frame. As you can see right here, price taps into this area, but look what happens. It takes out the range low, and when price starts to expand, it takes out the range high of the previous candle. We can use it on the daily time frame and understand that this could be maybe our previous daily low, and this could be our previous daily high. Using this to also form out our sort of daily buys, as well as on the low time frame, you end up seeing price taking out the previous low, sweep that out, and then continue the upside. Example of this, right over here, we see we created this fair value gap. Price makes a wick into that area, so we can identify this as our immediate tap and go. Looking at this on the lower time frame, we now see a perfect resolution of the turtle soup model being in play. Price makes a high in, and then we see price make a wick reject, turtle soups the high, and then we have a perfect move to the downside. Having this turtle soup model gives us the perfect entry model to execute on the lower time frame and have a full-on trade. And here is an example of our fair value gap with the CTR model. Once price makes this three candlestick pattern of the fair value gap, here's our gap in price. You see price look into this area, take out the range low and expand, taking out the range high. Once again, coming for a second entry, another reversal, and then price takes out this range low and then takes out this range high. Perfect resolution of the candle range theorem. Even on the low time frame, also becomes clear as day. We also identify a turtle soup model. Price makes a high, short-term low, expands up, but price comes back into the fair value gap and then sweeps out that turtle soup low. We now have a perfect change in state of delivery entry targeting the most recent high. So perfect confluences being used in our fair value gap theorem. Very important note here. If the third candle of your fair value gap, okay, has liquidity above the high in a bearish example or liquidity below the low for a bullish example, there will be a high chance that price will purge this area, thus validating a tap into the fair value gap. As you can see, the third candle right over here, if it has liquidity, we can see price come down and purge that area and then expand up while filling our fair value gap. As you can see right here, we had short-term liquidity above this high, price comes up, purges it, and then fills our fair value gap and continues to the downside. Now, what are the other concepts you also have to have in mind? The liquidation before the tap and go. So this now coincides with our prolonged reversal. If you don't see price come and tap into our zone immediately, we can always expect price to rally up and then sort of create this liquidity just before tapping into our fair value gap. In a perfect bullish example, we have price creating buy-sell liquidity before tapping into our fair value gap and then expanding to the upside. This is the daily time frame of NZD/USD. We can see we have this fair value gap being created right over here. Three candlestick pattern. Candlestick 1, candlestick 2, candlestick 3. Main importance is candlestick 3's high is separated from candle 1's low point, creating this fair value gap, okay? And as you can see, we then have a tap into zone. But if we investigate and go down to the lower time frame, what do we see? The third candle actually has liquidity above it. It creates this sort of trend line liquidity, which we then see price purge aggressively, tap into the fair value gap, and then have the major reversals to the downside. Right over there, you could have found your change in state of delivery and then continue to the downside. Perfect daily bias with a lower time frame entry. Here's another example of this. 1, 2, and 3. the third candle, we start to see it creates this little sort of trend line right over here. Go on to the lower time frame to see this much more clearer. We see price creating this trend line liquidity. It expands to the upside. However, this fair value gap is left untapped. But what is price going to do next? It then expands and comes down, sweeps out this trend line liquidity, reacts off our fair value gap, okay? Gives us a change in state delivery and then continues to the upside. You would have found your lower time frame interval right over there, enter your trade and then just target to the highs. Simple as that, guys. Okay, so we always want to look to see if we have a bit of liquidity being created with that third candle, because that will always validate future moves for our especially prolonged fair value gap fills. Right over here, 3 candlestick pattern, 1, 2, and 3, fair value gap created, okay? Once again over here, looking at the wicks right over here, we can see we have liquidity being created, okay? Number 1, short-term low, because there's liquidity, it creates a turtle model with price taps off fair value gap and initial reaction. Price then does it again and reverses, takes out this low too, creating yet another turtle model, then again tapping into our fair value gap, and then now we could have found a change state of delivery, entering our trade and then targeting high. But as you can see, there was liquidity after price made our fair value gap, okay? So that also adds to price making, having a reason to actually come down and fill the zone and then start moving to the upside, okay? So now that you guys understand how to fully use the fair value gap to its utmost potential, you need application of this skill, which is why I have my full-on Discord where I go through all my trades every single day, especially using this advanced theorem of the fair value gap, as well as going live on YouTube every single day at 8 AM Eastern Standard Time, where you guys also can watch me live trading this with you guys and also learn this concept much more in depth. As always, guys, make sure to watch our previous videos both on the CTR model as well as the turtle model. As well, if you want to improve your entries on order blocks, I also have another video there for you guys. And as always, guys, unfortunately, guys, this is real trading.